Welcome to Talk Tickers. We're your shortcut to getting truly well-informed on the most important earnings calls.
We cut through the noise for you.
Exactly. And today, we're digging into PagerDuty's second quarter results for fiscal year 2026.
Yeah, the market reaction right after the call was, well, it's interesting. Definitely complex.
It really was. A bit hesitant, maybe. It suggests there's more going on beneath the surface, and that's what we're here to unpack.
We'll focus on the insights that really matter, give you the full context.
Okay, so let's kick off with a quick snapshot of those results, because they really do set the scene.
It was definitely a mixed set of numbers for Q2.
Yeah, on one hand, you had non-GAAP earnings per share coming in strong at $0.30.
Which, I mean, that handily beat the consensus estimate. Was it $0.20?
Yeah, $0.20. So a really solid beat on the bottom line there.
But then revenue, that came in at $123.4 million.
Right, just a fraction below the consensus of $123.6 million. Still represents 6.4% year-over-year growth, but, a slight miss.
And that difference, strong earnings, slight revenue miss, that's often a first clue. Suggest efficiency gains? Maybe, but perhaps some top-line pressure.
But here's the really big headline, I think. PagerDuty hit GAAP profitability.
For the first time ever. That's huge.
It really is. GAAP EPS of $0.10, GAAP operating income of $3.6 million. That's a 2.9% margin on a GAAP basis.
And remember, GAAP is generally accepted accounting principles. This isn't some adjusted figure. It's the official standard.
Exactly. And their non-GAAP operating margin was even stronger, 25.4%.
Yeah, up 800 basis points year over year. That's a massive expansion and well above their own guidance.
Really shows that operational discipline focus.
Absolutely. But then you look at other metrics. Annual recurring revenue, ARR, that grew 5% year over year to $499 million.
Okay, but maybe not spectacular growth.
Right. And the dollar-based net retention, DBNR, that eased back to 102%.
Down from 104% the previous quarter.
Exactly. So existing customers are still spending slightly more. That's what 102% means. But the rate of that increase slowed down. That definitely got investor attention.
Suggests maybe some churn, some downgrades happening within that customer base.
Seems likely. But on the cash front, they're doing well. Generated solid free cash flow, $30.2 million.
And they're sitting on a pretty substantial cash pile, right? $567.9 million in cash and investments.
Yeah, very healthy balance sheet. Gives them a lot of flexibility. It's especially important right now when software growth generally is, well, moderating.
Okay, so let's dig deeper into some of these strategic points, starting with that profitability pivot.
Yeah, that first ever GAAP profitable quarter really is the standout achievement.
And it wasn't just luck, right? It feels very deliberate, a real focus on operational discipline.
Oh, absolutely. Management made it very clear this focus on profit and margins isn't just a one-off. It's the strategy now.
They expect GAAP profitability for the full fiscal year 2027, I think they said.
That's right. It shows the business is maturing and they understand what investors want to see right now.
And to kind of double down on that, the board also boosted the share repurchase program.
Yep, to $200 million authorization.
Yep.
That signals confidence in their own stock, and it's a way to return some cash to shareholders.
Okay, so strong discipline on the cost side. But then we have those growth headwinds, like that dip in DBNR.
Right, the 102%. They said it was mainly due to higher churn and downgrades.
Customers optimizing seats, tightening belts, that kind of thing.
Exactly. Organizations are scrutinizing software spend, trying to get more efficient. It's a common theme.
But here's where it gets really interesting and maybe a bit counterintuitive.
You mean the platform usage?
Yeah. Even with DBNR easing, PagerDuty said platform usage actually grew significantly, over 25% year over year.
Think about that. Fewer seats being paid for in some cases, maybe, but people are using the actual platform more.
Which totally validates their strategic shift towards usage-based pricing, doesn't it?
It absolutely does. If automation means you need fewer licensed users or seats, but the underlying platform is handling more incidents, more automated actions, the old seat model doesn't capture that value.
So the new usage models aim to align the revenue with the actual value being delivered. Makes sense.
It does. But the transition, that's the tricky part. Moving existing customers from seat-based to usage-based, that's complex.
Yeah, you often see a temporary dip or trough in revenue during those kinds of transitions.
Exactly. PagerDuty is saying this will be gradual over the next couple of years, often happening as contracts come up for renewal.
But there was a bright spot there, wasn't there? The product's already on usage-based pricing.
Yes, those grew over 60% in the quarter. That's a very encouraging sign for where they're headed, even if the overall transition takes time. The market will be watching that closely.
Okay, so challenges with existing customer expansion, but signs the new pricing model works. What about bringing in new business?
Some positive signs there too, actually. New and expansion bookings were up over 15% sequentially.
Sequentially, okay. And customer adds.
Pretty strong. They added 208 net new customers in the first half of this fiscal year. That's nearly 3 times the ads they got in all of last year.
Wow. Okay, so new customer acquisition is picking up pace.
And importantly, the high-value customers, the ones spending over $100 Ks a year, that group grew too. Added 20 sequentially, up to 868 total.
So the land and expand motion isn't dead, especially at the higher end. That helps offset some of that DBNR pressure.
It's crucial. You need that new business and expansion in key accounts to fuel growth when the broader base is optimizing.
Now let's talk AI. PagerDuty is positioning itself as, what was the phrase? The central nervous system for the emerging AI ecosystem.
Huh. Yeah, pretty bold claim. But they are backing it up with action.
Like the integration with Amazon Q business.
Exactly. An AI-powered chat-first integration using PagerDuty Advance.
Yeah.
They mentioned leveraging over 40 data connectors to bring more enterprise context into incident response. It's about embedding AI practically.
And they've got new AI products coming soon too, right? 4 new AI agents.
Yep. Shift, Scribe, Insights, and SR. All set for general availability this next quarter, Q3.
And crucially, these will all use usage-based pricing.
Reinforcing that strategic shift again, building the future revenue stream on that model.
Makes sense. Are they seeing traction with AI companies already?
They are. They highlighted that native AI companies now make up 2% of their total ARR and are growing fast.
And something like half the Fortune 50 AI companies are customers?
Over half, yeah. That definitely lends credibility to their relevance in these very dynamic AI-driven environments. Plus, they got that AI Ops Platform of the Year award.
Okay, so the AI story seems pretty compelling. But executing on all this profitability, pricing changes, AI innovation requires strong leadership and sales execution.
Which brings us to the go-to-market changes. They appointed a new Chief Revenue Officer, Todd McNabb.
Starting soon, end of September, he's got a long track record in enterprise sales.
Yeah, over 25 years. This move seems like a direct response to what they called inconsistent performance, especially in North America sales.
They also mentioned flattening the sales structure a bit for more agility.
Right. Trying to speed up decision-making, make the sales engine more effective at capturing those enterprise deals, especially with the new AI products coming online.
And it sounds like some parts of the sales org are already performing well. International did well.
Yeah, international regions showed marked improvement, actually beat their targets. So it shows the platform demand is there when the execution clicks.
Good sign. And the sales team itself is getting more experienced.
Over 60% of their enterprise reps now have at least a year's tenure. That experience is vital for complex deals.
And the chief customer officer is focused on retention, renewals, keeping the existing customers happy and growing them where possible.
Exactly. Allison Corley's role is critical for stabilizing that ARR base while the new growth drivers kick in.
Okay, so let's pull all these threads together. What does this Q2 really mean for you, the listener, the potential investor?
Well, PagerDuty's results definitely mirror what we're seeing elsewhere. Software growth is slowing down. Investors are demanding profit, durable revenue, not just growth at any cost.
And PagerDuty's pivot towards profitability, raising the EPS guidance even while slightly trimming revenue, that fits right into this new market reality.
It does. But you have to look at the stock performance too. It's lagged the broader software index, the IGV ETF, over the past year.
Meaning it hasn't kept pace with the overall sector. Lower software beta, as they say.
Right. It highlights that the market still really cares about that top-line growth. And the DBNR slowdown is clearly a concern for investors. They need to prove they can re-accelerate.
And looking ahead, they're guiding for a stronger second half of the fiscal year, right? Expecting incremental ARR to pick up.
Yeah, they're banking on the maturing sales team, the new leadership in North America kicking in. They guided Q3 billings growth around 7%, and Q4 is their biggest renewal quarter.
So a lot riding on the next 6 months to deliver on that story.
Absolutely.
Yeah.
And then there's always that background possibility, the strategic alternatives talk.
Yeah, the Reuters report from late July about them exploring a sale. That definitely put a temporary floor under the stock.
It remains a potential wild card, a catalyst that could pop up again.
Okay.
But fundamentally, the investment case hinges on showing that AI strategy can reignite growth without wrecking the new profit structure.
Okay, time for our This Is Not Financial Advice segment. Just a bit of fun exploring some, let's say, creative angles based on the results. Remember, insights, not recommendations.
Strictly hypothetical.
Okay, idea one. The quiet turnaround, long play. So you could take a contrarian view here, look past the market's maybe knee-jerk negative reaction to the guidance tweak.
Focus on the fundamentals.
Exactly. Focus on the solid profitability, the strong free cash flow, that strategic shift to usage-based AI products. You'd be betting that the new CRO, Todd McNabb, and those 4 new AI agents coming online.
That they'll be the catalyst to get ARR growing faster again, maybe in FY27.
Right. It's a longer-term bet. A play on the company successfully navigating this transition and emerging stronger, more profitable, and growing again. Seeing the quiet transformation others might be missing.
Okay, that's the patient approach. What about something for the more adventurous?
All right, idea 2, a strategic surprise options bet. This is definitely more aggressive. You could look at an out-of-the-money call option, maybe expiring sometime early next fiscal year, FY27.
So a call option gives you the right, not the obligation, to buy the stock at a set price. Out of the money means that price is higher than where the stock is trading now. Cheaper option, but needs a bigger move to pay off.
Precisely. It's a leveraged bet on a significant positive surprise happening relatively soon.
Like what kind of surprise?
Could be anything, really. Maybe the new CRO hits the ground running and sales reaccelerate much faster than expected. Or maybe those new AI products get adopted way quicker, leading to an ARR beat.
Or that strategic alternatives chatter fires back up. A potential takeover bid.
Exactly. That could definitely cause a sharp move. Options market volatility is already suggesting a decent-sized move is anticipated, so a well-timed bullish bet could pay off handsomely if a positive catalyst hits. But
big if. High risk, potentially high reward, very speculative.
Very speculative. And just to hammer it home one more time, these are just thought experiments, potential narratives, not financial advice. Do your own homework.
Always.
So, wrapping things up. PagerDuty's Q2, really a pivotal moment. That first GAAP profit is a huge milestone.
Huge. But they're juggling that achievement with navigating customer spending optimization and this big shift to usage-based pricing.
And they're betting heavily on AI and their new leadership to reignite that growth engine in the year ahead.
It's that delicate balance. Can they keep the profitability gains while getting the top line moving faster again? That's the key question the market wants answered.
Which leaves us with a final thought for you. In this world rapidly converging around AI and operational efficiency, how effectively can PagerDuty leverage that central nervous system positioning? Can they use it not just to hold their ground, but to actually reclaim clear leadership in the incident management space?
It's a fascinating challenge, reflective of what many tech companies are facing right now.
Indeed. Well, thank you for tuning in to Talk Tickers today. We really appreciate you spending your time with us to get these valuable earnings insights.
Remember to always do your own research.
We'll catch you on the next deep dive.